Ahoy there, traders, and welcome to our weekly workshop. We've already called a few names out. Hello, but yes, thank you for taking a moment out of your day to spend it with little old me. So we've got something fun planned later. I've got a few things for us to go through, but I've got a little visual exercise. I really think you're going to find this fascinating. It's not practical in any way from a trading point of view, other than as a great learning tool. So you wouldn't trade this way, but you would certainly use it to speed up your learning curve. But that's what we're going to look at, how to get 20 years experience in 20 minutes. We'll have a little look at that later on in today's programming schedule. But we're looking at our portfolio. We're going to be reviewing some positions and taking a little look over my shoulder as we look at the markets. The usual format is we're going to spend 20 to 30 minutes looking at the markets. 20 years and 28 minutes. Forgot to update that again. Have a little look at the market overview. I've got some positions to review, so I want to go through those. That's part of what we do. And then we're going to look at 20 years in 20 minutes. Right, so 20 years, 20 minutes. Right, okay, so just skipping down, see if there's anyone in a minute. We've got Rodrigo, hello, Ruben. Stuart, Vito, great. Brian, hey Brian, how you doing? Hopefully you're feeling better. But yes, nice full house again. If you were just stepping in, thank you for taking some time to spend it with me. So there are one or two new names, and if you are new to Phil's weird world of trading, I'm not a Wall Street guru. I've not worked in the city. I did attempt to make a venture into the city, and I took very badly ill before I made it there, and a few wrong turns, and we didn't quite make it to Albuquerque. But I'm not a Wall Street guru. I am somebody who figured it out. I cracked the code. I did it the hard way. I can only say that looking back on 20 years of doing this, there is certainly an easy way, and it wasn't the way I did it. But the easy way is to follow in the footsteps of someone else. I didn't know other traders that existed when I started out. But nonetheless, where I'm at now, I like to genuinely goof around. I'm just a regular guy, found a little bit of success. I like to spend most of my days drinking tea or coffee and reading a book. That's usually how I spend my mornings. I generally don't take life too seriously, and that's just how I want to live my life. The one thing that is consistent over the years is I am truly passionate about helping other traders see success, which is one of the many reasons why I do these little workshops every week. Quick backstory. I've been trading full-time since 2001, was hand-drawing charts since the 90s, calling out my trades in real time since 2004. I've managed a few funds actually over the years and private clients, and consulted with them and a few other bits and bobs. I've generally been behind the scenes and kept myself to myself over the years, but again, I have been doing this for 20-ish or years now. 12 of those years, I specialized in Forex, actual currencies, not this fake digital thing that's going around at the moment. No doubt it will be legitimate soon, but just right now, it's not worth looking at. Currently, I specialize in stocks, options, occasional toe dip in futures, and have done for the last 10 years now. Wow, time just marches on. I've mentored and coached thousands of students from retail all the way through to banks, hedge funds, institutions. I also white label what I do. There's, maybe you've seen a lot of my products and you don't realize that they're my products. Anyway, I am obsessed with helping you. That's all that matters. That's why we're here, and that's what we're going to get going. So without further ado, let's hit the charts, baby. Phil's in a crazy mood. The coffee is just kicking in. I've had far too many of those little pods, Tassimo things. Random funny thing, while I get my drawing pencil, because I can't quite find it, is I bought the Betamax of coffee machines. You only know with the benefit of hindsight. There's not that much choice of coffee with the Tassimo. Nevertheless, I'm due an upgrade. So thinking about the markets then, as always, I've changed my color scheme. It should be a little bit easier on the eyes. But as always, I look left, and this time I'm looking at the watch list. I always start here to just get an overview of what's going on in the markets. I'm looking at the percentages more than anything, as opposed to the point values. As a percentage, again, if we were looking at this time last year, this would be like, holy shit, look at that move. It's what a clonker would be the phrases that we'd be going through. But right now in the current market environment, this is pretty quiet. 130 points on the Dow, 0.4%, Nasdaq's 0.7, kind of leading the charge. The Nikkei is what catches my attention as we come to the weekend and the month end. The Nikkei Japanese futures are powering away, and they've been a little bit lackluster, as you can see here, for most of the year. But again, they're on a tear, which could be interesting. It could be leading a leading indication of what to expect with the US futures. Again, Russell's already in lockstep. Look at that. It's like we're looking at the same chart. So it's already powering away. I've got to admit, Russell, really, you're leading the charge. You've got to wonder. Again, this is really has me thinking, the difference between Wall Street and Main Street, there's such a huge divide, but hey, stocks only go up. Buy the stonks. What can you do? Nasdaq is a little bit laggard, as you can see here. It is range bound, certainly compared to the S&P, which we looked at last week. What we're waiting for here is a breakout, and the scenario that we hypothesized last week was that, hey, until something new happens, same thing's going to continue. Ergo, we're in a range that's not unlikely to change anytime soon. So we'll probably see price oscillate back and forth. So last week I had this bearish, neutral to bearish viewpoints. It's been more neutral and slightly bullish over the last 2 or 3 days. So, nothing major to write home about. So it's kind of done what we expected. Not exactly how we thought, but nonetheless, it's doing what we thought it would do. Same with the Dow. One of the scenarios that we were looking at was the possibility that price might break back into this main range here. And, it's still meandering sideways. Technically, still with that very slight bullish bias over the last few days. So again, prices unfolding the way that we thought. As we go into the new month, again, last Friday of the month, last weekend of the month, all the rest of it. But as we go into the new month, this is starting to look like, well, we could see a really strong bullish December is what we could be thinking about. So the secondary scenario that we looked at last week, which was maybe bullish, is starting to look more favorable this week with new information. One of my favorite quotes is actually from W.D. Gann, I think from the 1920s. I'm paraphrasing. I don't quite know exactly how it was phrased, but you can imagine in the 1920s, the way that we spoke English was a little bit different to how we speak it today. So paraphrasing, it goes something like this: always be prepared to change your mind. And in trading, never a truer thing has been said. I think I would add the extra bit of saying with new information. With new information, always be prepared to change your mind. So one of the things that we want to look at is, and I've got to admit, I'm kind of reminded back here, I was locked into the mindset of bearish. And it took me a while just to break the mindset. And this was a lesson I relearned, and we documented it at the time. We talked about it so that, you could see how we deal with it in real time. But as humans, as traders, just as people in general, we've got a cognitive bias. So one of the things that we're always trying to strive towards is that opinion neutral. So the way that I would usually combat it is, like, what are the scenarios? There's only 3 things that price can do. Price can go up, down, or sideways. So we think about one of those 3 scenarios, and then when we have new information, 2 or 3 days, 2 or 3 weeks, whatever, then we can start to say, oh, well, it's actually looking like scenario number 1, scenario number 2, or scenario number 3. Oops. And, whichever, up, down, or sideways, basically, chances are it's going to be a combination of, 1 and 2 or 2 and 3. It's going to be a little bit sideways, a little bit bullish, or a little bit sideways, a little bit bearish. It's usually a little bit of a hybrid of the scenarios. But if you think at its most basic, up, down, or sideways, and plan for scenarios, then you won't do what I did way back here, which is I was bearish. And even right now, my opinion is I have never been more bearish in my life. Just look out the window. Main Street's on fire. The economy's in tatters. Millions of people dying, unemployed. It's like, what the fuck's going on? And yet stocks go up. So there's such a disparity. But right here, that's where I got stuck in the quagmire of my opinion was bearish, but I didn't update my viewpoint until about here, if I'm going to be honest. So there is where I got my ass handed to me. I'm very happy to, well, not very happy. I'm very open to say, you know what? That's just the way it is. It's a fact for anyone who's followed me for any length of time. You know, these things happen, but that is just illustrating the always be prepared to change your mind. Always be prepared to change your mind. And this is where I changed my mind. Okay, something new, something weird, something different to what I expected. My opinion happens, and maybe we should look at the charts, Phil. Maybe you should get back on track. So back on track. Stocks are going up. They only ever seem to go up. We're back in a little bit of a range right now. This is technically a breakout. End of the month. Half day today. We're coming on the back of a holiday. Probably not going to see anything major happen. Everything's going to start for that March forward in December. We've also got a reduced month in December. The reality is we've got probably 2 weeks, usually the first 2 weeks of trending movements. And it's usually and historically cyclically bullish. So we've got something new happening. We're just waiting for that to happen. Again, what we expected was neutral to bearish, you know, through the second half of November. That's happened. That's unfolded as we thought. So the second part was, you know, beginning of December, we're probably going to start to see that bullish March. We're looking at a break up and out. Need to see a new high above 30,000 on the Dow, and we'll start to see a very nice, probably very strong bullish start to December. And then we're into that, you know, 10 days, 2 weeks of the Christmas week, New Year week, at the wind down. Again, if you think about the stock market just like an office environment, it's full of people who are, again, it's not like in the old days where it's pit, but it's like an office environment. You know, you're going to take breaks at 11. You're going to go for a quick smoke break, and you know, maybe don't want to mess up their bonuses for the end of the month. And you know, it's people taking holidays, people taking sick days, people all, you know, it's that type of mentality. So the Western world is going to be taking a vacation middle to the end of December. So it's going to be trade, hard and fast, first 2 weeks of December. And then it's take the foot off the gas. Don't want to mess up my year-end bonus, my quarter-end bonus, my month-end bonus, whatever the institutional trader logic is. But then I don't really want to do anything new until after the holidays, the new year. Don't really want to get stuck into doing things. So I'm just going to coast until then to make sure that my bonus is secured. So usually we see this little quiet period the week before Christmas. And then we would normally see that that Christmas week is quite, again, for obvious reasons, skeleton crews banking the trade desks. So probably going to be really quiet. So that's usually how the month goes. And again, you can extrapolate that from the fact that it's just like a regular office. There's going to be skeleton crews. There's going to be less people doing things. If you think about the traders, what they want, what they're doing, again, the institutional banking traders, they don't want to mess up their bonuses. So what's the incentive to do anything new, do anything interesting other than kick the can down the road? So first half of December, probably going to be bullish. Second half of December, neutral with a slight bullish incline is the historical expectation. And then it's January. Well, we're into a new year, and we'll see what happens there. But so far, the charts are looking like, certainly on the Dow, looking like they might support that bullish hypothesis as we go into December. The S&P, let's take a look at that. Again, we've still got that range. We're breaking above the high there. So there's that, again, possible bullish hypothesis above the highs. We'll start to see that again. hypothesis unfolds, the Nasdaq's the fly in the ointments, really. It's not doing anything new just yet. And as we kept saying, until something new happens, something new we can classify above 12,500, until something new happens right above there, then this is probably going to continue. So Nasdaq is doing something a little bit different. And if you think about what's been going on in the news the last few weeks, we've had that, or what's the fancy phrase, cycling out, sector rotations, or other phrases that you may have seen. So, tech and the COVID stocks, dare I say, are currently out of favor, which is why we're not seeing anything major go on at the moment. And all the old tech, the old technology, the S&P, the Dow stocks, the Russell stocks, they're starting to play that catch-up move. So it may be that, that sector rotation just means that there's less short-term interest in tech stocks, which might support that, hey, maybe Nasdaq stays range bound through December, until we see a breakout, until something new happens. That's what this is suggesting to me. So S&P, Dow, Russell, December trend. Conditionally, until we see a break on Nasdaq, we're probably going to see this sideways meandering continue. And that's the way I'm reading the charts for at the moment. Let's take a look at, so that's how I'm reading the charts. That's how I'm reading the charts. Very quickly, I do want to go on to how we find stocks, how we scan for stocks. Because one of the things that we frequently have been focusing on the last few weeks is, how do we find green light trading? I'm having a lot of fun trading short-term trading in my own accounts. The short-term trading, fast profits, explosive moves, basically just trading the first hour of the day. And it seems to be resonating with a lot of people. So I'd like to just spend a moment looking at how do we find something to trade today? How do we find a green light trade? It's a yes, it's today type of trade. So let's take a look at how we do that. One of the ways that I like to do it is I've got two layouts. This is my let's find something to trade layout. So I've got a daily chart, I've got a 60-minute chart, and I've got a 5-minute chart. So what I'm looking at primarily is, do we have stocks that are gapping? And I would do this as the pre-market starts, but typically about now, about 9 a.m. Eastern would be a great time to do this, because we've got stocks that are gapping can be found, because this is all the pre-market activity. But then what we also want is, has there been any institutional interest? So I can get the pre-market volume. So this is live as of right now. So even though the market's not officially open, there's actually a pre-market, and then there's a pre-market. I know, don't roll your eyes, I didn't make these rules up. But we have activity before the market opens. So one of the things that, again, I like to do is basically just look down, is there any big dollar movements that could be catching my eye? And then just see if it's potentially going to be a real gap. So what I mean by a real gap is Cyber here has got potentially a gap of $3, but there's only so far been 500 shares traded. So does that mean that it will be a genuine gap? Is there institutional interest there right now? Probably not. So what does it look like? If I look down at the movements, you can see that there's some huge interest. And what I'm also trying to do at the same time is look, left and right of this column. I'm looking at the volume now and the average volume. So I'm just trying to say, like, is that a big number compared to its average? And in the pre-market, that could be a significant footprint. So what we have here, GlaxoSmithKline, GSK, is it's not a huge gap as a dollar amount, but we've got this whopping 200,000 shares traded already. That's pretty significant. And obviously, pharmaceutical stocks are very in favor at the moment. So we can find a footprint for excitement. The other thing that you can see is, I don't know if you can see, like, my tickers are flashing yellow as well, yellow background. And on something like Tesla, which is, it's pretty active all the time. As soon as it can be traded, it's traded. But can you see that the pre-market volume it's going up. It's spinning like dials on a fruit machine. It's like ding, 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 ding. It's spinning fast. And you can also see Zoom above it is kind of doing the same. So that's what I'm looking for. Is there significant pre-market interest? So maybe it's not a dollar amounts on the left. Maybe I can see the numbers ticking up and down. Again, Alibaba, we can just see it's not going as fast. Facebook's kind of clocking up and down, but we can see that there is interest in the markets. And again, the one that I'm saying it, the one that catches my attention is Sage, resisting the urge to make the connection between Sage and Onion. But we've got Sage, number 18 on my list, SAGE, 500,000 shares traded. And the current average over the last, I think I've got it set to 14. It's either going to be 14 days or 100. I can't quite remember. It doesn't really make much difference, to be honest. They're all about the same. But it's almost done its average volume in the pre-market. So Sage, can everyone see that? So while I've got dollar movements, again, the Amazon's 80,000 shares on Amazon, not that much in the big scheme of things for Amazon at the moment. Tesla, 2 million shares in the pre-market. I've got to admit, it's not that much in the big scheme of things at the moment. It's kind of normal. So when you start monitoring these things, you'll see that, Alibaba doing 200,000 shares in the pre-market. That's kind of what it does normally at the moment. So you get to see the same names highlights, but this is the one that catches my attention. I've not seen Sage on my watch list for quite a while, and we've got big move, dollar move, percentage move, about 4%, and it's done its average days volume already in the pre-market. So that means that there possibly is significant interest at an institutional level. There's probably going to be elevated interest through the regular market activity. So just catching up on can everyone see that while I just catch up on some of the comments? Just give me a little hell yes. That looks interesting. So why this stock versus all the others? That's the reason. That's the logic. Takes longer to explain than to actually do. Just seeing your questioning, the pre-market and the pre-pre different from futures. Yes is the short answer. So futures, Globex futures, and generally futures in the last 15 to 20 years on Globex, they're traded effectively 24 hours. So you have an overnight market is how it would be phrased, and a regular market activity. You could argue it's just semantics on wording. So futures, you would refer to it as overnight futures. And in stocks, you would just say pre-market, because it's not traded overnight. It's just traded for 2 or 3 hours before the official market opening. So it's just, again, just a difference on wording. Again, futures effectively 24 hours a day, not quite, but close enough. And stocks are traded. Pre-markets starts at 8 a.m. and the pre-market can be anywhere up to 4 hours, and it may be traded or it may not be traded anywhere up to 4 hours, 4 or 5 hours prior to the official start of the trading day. So hopefully that answered your question, Ian. So Sage. So now I've not even looked at the chart yet. So ignore this. We've not looked at the chart yet. This is a different stock. So let's go and take a look at Sage. What I want to see then, what I'd want to see is even though it's, there we go. Even though it's there right now, I've got pre-market data. It's been up to $100. So what I'm looking at, daily first, where is the gap? So we're at about $88. And this is 85. So 88 is way off the top of my chart. So firstly, it's making new high. If we were trading this on a swing chart, breakout, pullback, my apologies. It's waving higher, but it's broken to a new high and jumping significantly higher. So we've got something interesting. So that move above this prior swing points, it could be highlighting potential fresh liquidity, either buying or selling. Anyone who's short has been stopped out. Anyone who's long is very happy, maybe wants to cash out. but there could be a lot of excitement with getting new positions on for short-term trades, or maybe unloading positions for an institutional. I suspect because of this uptrend, because of the multiple days, the bullish, because you've got green day, green day, green day, green day, although we've got a major gap higher, I would imagine that we would see price gap higher and trade lower, just because I would imagine it's going to be like an exhaustion gap is what I'm thinking on basically profit taking. That would be what I would be thinking. How do you tell which one's which? This is the voice of experience. When you've seen these things play out lots of times, you can start to look at that. But the main thing is we're in an uptrend, green bar, green bar, green bar, green bar. We've got basically it's gapping at the end of a rally is what's happening. So it could be an exhaustion gap. If we saw it gap for it, and if we saw it gap below, say 70, the opposite direction, then it's gapping down below green bar, green bar, green bar, just the opposite. So then it could be a gap and go is how it might be phrased. And because anyone who's long is being stopped out, anyone might have the stops there, they had that bullish rally. So if we had see it gap lower, and we saw the gap down through, say, $70, then it's breaking support, it's breaking previous green days, it's counter trend. Anyone who's long's probably crapping themselves to get out of positions, and that might create selling pressure as people get out and stop out. And then there's all the day traders like you and me who want to maybe look. So that would be a gap and go type of setup. The difference between the two, sometimes they're referred to as a novice gap in an exhaustion, the first scenario, and the second scenario is sometimes considered a professional gap. It's just how the setup develops is dictating which one's which. But anyway, Sage looks interesting. I'm going to pop that on my little apple peeler list. And we'll come back to that in the main market. So I'll have a look at that. So 10 o'clock Eastern. What I'll do is I'll check in, see if there's a trade. It's either going to be a green light or a red light setup. Green light is put the trade on. Red light is come back next week because it's Friday. Come back tomorrow, essentially. It's either go or no go. Setup's either there or not there. And I've got some exciting things with the setup. We've managed to codify it. So anyway, net change, I'll come back to that in a moment. Net change is $1. Net change is a percentage. If I'm sorting as a percentage, I usually stick to anything that is over 2% approximately. And then so I've only got 5 stocks to evaluate, and then I'll look down volume. So GDX, again, ETF, I'm not worried about it. AZN, AstraZeneca, 700,000 shares. It's kind of been doing that already, so it's not doing anything that is exceptional at the moment in the pre-market. So it's kind of normal pre-market trading. Again, voice of experience more than anything. Let's check out the percentage gainers. Anything over 2%. So again, I've only got 10 stocks to evaluate. So when you look at the pre-market volume, there's only 2 that really stand out. Does that make sense? So I'm only looking at those stocks. So when I'm not looking, although I've got 50 in view, I'm not looking at all of them. Does that make sense? So it takes longer to explain than to do. So Sage, Zoom, and that's it. I could go down the list, maybe CRM. Why CRM? It's got 200,000 shares traded nearly in the pre-markets. Could be interesting. I've not seen it on the list for a while. It's almost 2%, so a little bit of flexibility there. Momo looks interesting. It's not quite 100,000 shares. I'm using 100,000 shares in the pre-market at the moment just to answer 1 or 2 people's questions. Because there's so much activity at the moment, because of all the bullshit that's going on, having that significant pre-market volume is a good qualifier. It's going to give you 5 or 6 stocks that may be on your list. And as we've just seen, there's only really 2 or 3 that look interesting when you factor in the gap and the volume. If we were looking at this time last year, you could use 20, 30,000 shares, 50,000 shares. Pick your poison. It doesn't really make much difference. Just pick a number. It's going to be a lower number under normal market conditions. So right now I'm using 100,000 because of everything that's going on. You can come right down 25, 30, 50,000 shares. What you'll do is you'll see what is kind of trading the pre-market. So what you could also do, if there's nothing too obvious, you could sort by volume. And then we've got, here's all the stocks that have traded 100,000 shares. So there's 30 stocks for us to check out. And then you can go and evaluate and see. And again, what we're looking for, is there a gap? Is it jumping past resistance or supports? Is there a lot of pre-market activity, which we can see on Sage? So these all look interesting. So that's how we find something to trade, folks. That's how we find something to trade. Nice and simple. It just gives me 2 or 3 things that look really interesting. And now that the opening bell's gone, you could possibly do the same thing again at the opening bell. It's a little bit fast and furious, as you can see there. Everything's out the gates. So better to do this in the pre-market rather than when the market opens. It just makes it a little bit easier to sift through the weeds. Quick slurp. Comment from Ian: is the pre-market influenced by spoofing? The pre-market, you can only trade market orders, so you can't put stops and limits in the pre-markets. So it's only like market order, go or no go. So there's nothing to cancel. So you can only place stop and limit orders in regular market trading. They'll only be filled in regular market activity. They won't be filled in the pre-market. So a good illustration might be, okay, the market's just opened here on Sage, several dollars higher than the last open. So anyone with a stop loss here, it won't be filled in the pre-market. So it's only going to be filled at the next best available price in the regular market. So there's less chance of that happening in, or there's no chance of it happening. So it's market or not. So just a question about spoofing and getting filled and all the rest of it. Right. So what's next on our agenda? Oh yeah, a quick review of the short-term strategy. Quick review. Where are we? So a quick review of the short-term strategy. The first part of what we do to find stocks to profit from explosive movements is relative to this strategy. This is the funny thing is, this strategy, this is not a million miles away from what I used to do for 12 years. When I was 12 years a day trader, this is what I would look for. I would look for pre-market ranges and trade breakouts. That's essentially what I do. So it's a little bit of a variation of the same thing, but I'm looking for pre-market activity and I'm looking for explosive morning movements. I basically made a 12-year career doing this. So the first thing that we do is we find something that is potentially explosive to move. We've just been through that. We've just had a look at explosive opportunities. So what I'd like to do is just go through and show you some examples. There were 64 trades in November. So I just want to review the month. 64. I'm not going to go through 64 trades, but there were 64 trades on 4 stocks, a core list: Apple, Microsoft, Facebook, IBM, NVIDIA. They're stocks that move regularly on a daily basis. So just looking for those morning explosive movements. You don't even have to scan for stocks. You can just very simply just have 3 or 4 stocks. And this means that if you're not hunting for opportunities, you're just kind of fishing and waiting for the setup on an individual stock, then that means you can have a core list. About 3, 4, 5 stocks is really manageable. And this means that it's, again, I nearly said passive. It's not passive. It's just a low time investment. It's not passive. It's just a low time investment. We can do it in the first 90 days. And this is the whole idea of this, or my preferred style of trading. I don't want to be looking at every chart every day all the time. I just want to go, these 3 stocks are what I'm going to look at today. And if you don't even want to hunt for the stock, because that scanning, maybe you're not confident to go and scan. Maybe you're worried about missing out. Just look at 4 stocks. And if you looked at 4 stocks in November, then you would have seen some straight line equity results. They've been pretty impressive. And if you want to trade the stock on them, you're going to see a similar equity curve. So let's go and take a look at some examples. This is Apple. If you just looked at Apple this month, you would have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 setups in the last 20 trading days. So 10 setups in 20 trading days. So if you're worried about the pattern day trader rule, because I appreciate everyone's personal financial situation's a little bit different. And if you're under the pattern day trader rule, if you've got a small account and you're going to have those restrictions, then you just look at one or two stocks. It's set up one trade every other day on average. That's it. One trade every other day. So pattern day trader rule is you can trade 3 times in a 5-day period if your account balance is under $30,000 usually. You've got to maintain a minimum balance. Again, it's going to vary from broker to broker. The law is 25,000, but individual brokers sometimes have different rules or their own interpretation. So general rule, I usually say, if you've got $30,000, you don't have to worry about it. So if you're under that, you're probably going to be subject to, I can only trade 3 times in a 5-day period. And that just means open and close the same trade on the same day. So a day trade. So if you wanted to trade Apple, again, just look at it. You're going to have one trade every other day. So if you've got 3 or 4 stocks that you look at, you might have 2 or 3 trades in a day. You might have no trades today, but on average, you should be looking at 2 or 3 a week. So you can speed things up or slow things down on your production line to suit your situation. So if you're subject to the pattern day trader rule, just look at 1 or 2 stocks. Wait for the opportunities. So if you did that with Apple this month, this is what you would have seen. So we've got a nice setup. This is these markings. This is actually an automated. We've had this coded up now. So these are all not with the benefit of hindsight. These are all set up in real time. So we've got a partial trade there. You would have made about 50 cents, about 4% return on capital there. You've got 15% return. It's trade setup, target reached. So we're only looking for small gains. Again, I've explained this setup previously, so I'm not going to go through it now. But you would have seen these types of results. Again, you've got your nice gap and go type of setup on Apple, just more of a bonus. But you've got your setup there. You've got your nice trending move. You've got your push and pull back, and then it pretty much goes straight to target without very much headache. The stock does what it did, which is a $1.20 move, and the option you would have got about 50 cents on that day. You probably get between 50 and 75 cents on the option. So Apple, a small loss again. Again, you're not losing much. You're losing about 50 to 70 cents per share on the stock, and about 25 to 40 cents on the option. So yeah, it's still a small loss, but not significant, is what I'm hoping to illustrate to you. Apple, we've got rules for timeout. What if it doesn't get to target? You can still time out and make a profit. So part of the trade management rules, TTE, stands for timeout, target out, and exit out. It's either going to hit target, it's either going to not fill on timeout, or we're going to exit out for a loss, or we can time out from if it's going our way, but it's just not going our way fast, because we're looking for fast, profitable moves. So this one, you would have made some money, break even at worst, maybe 10, 20, 30 cents at best. So about 10% return on capital. Apple, again, another one that's timed out. It's not going your way. It didn't hit the stop loss level, the red horizontal red line there, but you can see that it's not gone to its target either. So you've got an opportunity to get anywhere from a break-even trade to a small profit on Apple. Again, another one didn't quite work out the way that you would have thought it, but if you could time it out, it works out reasonably well. If you'd held on through the day, this is one that would have, produced a gain. As it turned out, this was a break even. Apple, again, losing a little bit of money. It's not always puppies and rainbows, is all I'm trying to illustrate. But what you have with a consistent and methodical trading strategy, you get the moves, you get the perfect, because we don't know which one's going to be the perfect setup. There's actually 3 setups. I'm just marking one off, but you've got 1, 2, 3 trades on this. So you could have really accelerated the gains out of this one. You just took the first one, $1.20, 65 cents per share, 40.6% return on capital. And again, similar deal here. We've got Apple. If you want to look at this is only on 2 days ago, this week. And again, you've got your classic setup there. We've got $1.15, 75 cents per the option, 30% return on capital. So what I'm showing is the stock gain and the option gain. And this is all using one setup, finding stocks using the scan that we've been through already, and then using a very simple production line rule. You know, we scan for stocks, mechanical reason to trade. Then we visually confirm that it's going in the direction that we want. And then we place the trade the next pullback. Management is time out, target out, or exit out. 3 essential rules. And again, if you just traded Apple, you can see that it's a pretty decent month. You know, it's 1 or 2 trades a week. And if you really want to accelerate, let me just get this over. If you really want to accelerate the P&L, you know, you can trade other stocks than Apple. You know, it happens on Microsoft, happens on Facebook, happens on NVIDIA. You know, you can see the setups all from this month. There was 64 setups across 4 stocks this month, and they all produced a great return. Some of them were profitable. Some of them were timing out for break-even small losses. And there are obviously losses in there, as we've illustrated. So it's a mixed bag. But ultimately, what you have with any production line process, with any streamlined trading strategy, is its consistency. Consistency is the king. So what you would have seen this month is something that looks like that. If you've taken just the Apple trades, or if you've taken the all 4 of them on the Microsoft and the IBMs of the world, or the Facebooks of the world, again, you can scale things up or down depending on your personal situation. So that's just like kind of like the month in review. Just wanted to review November, the trades. We've been talking about this strategy for about 6 to 8 weeks on a regular basis. It's going to be a regular feature for me. So I'll be reviewing the week's trades in future, so you can see over my shoulder with a little bit of the benefit of hindsight. The other thing that we're doing is we're starting workshops as well. I'm going to be starting to do this live, kind of like a live trade room, kind of like a hybrid. I won't be doing it all day, every day. I want to just log in at 10 o'clock, put the trade on, and then see what's going to happen. So that's what I'll be doing in the future. If you are interested in profiting from short-term moves and you want to learn in the smartest possible way, then send me a message. Which it's as we've been. It's one simple pattern. We're going to look at the best stocks to trade, the best times to trade every single day, and you get to do it looking over my shoulder as it happens. And if that's of interest for you, I'm going to be starting the workshops next week. So send me a message if you are interested. Phil@AntiVestor.com. I want to make sure that what we do is right for you. So if it is right, then we'll discuss it. We can go through the details, but it's not far from what we've discussed already. And if it's not right, I'll try and put you off in the right direction. Ultimately, what I want to do is make sure that you've got the time and the means and the ability to spend about 60 to 90 minutes in the day just to follow this methodology and look over my shoulder. So that's where we're at. That's my big reveal. We've got the software that comes with TradeStation. We've had this coded up. So you've got a nice little assist every day with the strategy and the setups. So let me just take a little look. Let me zoom out. So all these chart markings. Oh, my TradeStation is acting a little bit slow. Just bear with me. So all these markings, they're all appearing for you in real time. So if you're not sure about the setup, you'll get an indication. So there's no ambiguity. There's no ifs, buts, or maybes. And you can see the last trade that we just looked at on Apple. Again, all this develops in real time. You'll get your entry, the stop, the targets. So if you're not sure, you've got a little bit of guidance. So with that said, let's move on. I spent a little bit longer than I'd planned on that. So yeah, that's just the way it goes. So let's think about how do you get experience? How do you get experience? How do you get 20 years experience in 20 minutes is a big question. It's one of those circular logics. How do you, when you're first applying for jobs, how do you get a job without experience? Well, you need experience to get a job. But if you can't get a job without experience, how do you get experience to get a job? You know, it's just weird. It's the same principle. You know, how you can only get experience by doing it. But how can we get a lot of experience very fast? And the key elements that I want to emphasize here more than anything, it's not just any experience. It's real-time experience. How can you get experience without the benefit of hindsight? Because if you're looking at daily charts and you're swing trading and you're wanting to plan, like what we did at the beginning, like I think this is going to happen next month or next week, we go through scenarios, but how do you get to speed up that process? Because I'll only find out if my scenarios are right that we went through at the beginning of this session. I'll only find out if they're right next month. So I've got to wait a month before I find out if I'm right. So what I want to do is speed up the real-time experience. And why I'm emphasizing real-time is if you were to scroll back through charts or look at a period in history, you have the benefit of hindsight. It's unavoidable that you would look at the charts that you're evaluating. Even if it's a passing glance, you've seen it, it's there, you've got the benefit of hindsight. So how do we get that chart experience fast without the benefit of hindsight? And a nice, easy solution is to look at fast timeframes. And as I suggested at the beginning, is what we don't want to do. We don't want to trade these timeframes. We don't want to trade these charts. But what we can do is put a minute chart on. Maybe that's too slow for this purpose. Maybe we want to put a 15-second chart on. Maybe, sorry, folks, my trade station seems to have locked up. Maybe we want to, I've got all my windows. There we go. Maybe we want to, there we go. Maybe we want to put second charts on so I can look at 15-second bars. And again, I just want to emphasize, you would not trade this way. It's not practical to trade. I know people who do. It's high frequency trading. I have done it. It's not practical. It's certainly not for a novice trader. So we're going to jump from a daily chart right down to a 15-second chart. That means that every 15 seconds, a new bar is going to develop and unfold. So let's just, while it's loading the data, 10 seconds or 15 seconds is one bar. Well, let's just think about it. 10 seconds would be one bar, 60 seconds would be 6 bars, 20 minutes would be 120 bars. If you were to look at 120 bars or wait for 120 days to develop, that's 6 months. So you can get 20 years experience if you can work in 20 minutes. If you work out how many bars might unfold in 20 years, it's 4,400 bars. So you could look at tick charts to speed this up. I personally think this is quite slow. This is 15-second bars. I'm just going to look at Apple as we're just past the open, just to kind of speed things up. I think this is a little slow. So if this is the right time frame for you, we can do our analysis. We can do all the things that we like to do. We've got a gap higher, we've got a trend, we've got price retracing, there's the consolidation. If we weren't looking at 15-second charts, you would probably think that this is the daily chart, because the daily chart looks exactly like this. How crazy, how bizarre. Does this mean that patterns develop and unfold on all time frames in the same way? Is it possible that it doesn't matter what time frame that you choose? So with that in mind, we can start saying things like, well, there's our average price. It's crossing higher. We're above the 200. Again, I'm following the process that we normally use. We're above the 50. Great. I'm bullish. There's the range. There's the breakout. Can everyone see this? I don't know what's going to happen next. But what I do know is I'm going to trade the next pullback. There's the pullback. It's developing right now. My entry is going to be above the next pullback high. There's the correction with prices breaking out. For illustration, this is working out just nice. Breakout, pullback. Where could it get to? Let's look up and left. Recent swing high would be where I'd be going. Does everyone get this? This is a little bit slower than I'd like, but 15 seconds, 120 bars. I can get 6 months experience of looking at daily charts in 20 minutes. Let's look at it a little bit faster. Does everyone get this logic? Does everyone get the principles? Is this making sense? How can we speed up the learning curve? More importantly, how can we speed up the learning curve, the experience curve, without the benefit of hindsight? Without the benefit of hindsight. I'm going to change this to 20 ticks. So every time price prints 20 times, it's going to give me a bar. So we've got the same, we just looked at that on the 15-second chart, but now on this time frame, it looks very different. Now what I'm seeing is this kind of rising channel, and it's possible that this is attempting a breakout, but now with new information, it's starting to develop this consolidation again. So same type of pattern on a smaller time frame. We've got a little bit of conflict with our mechanical trend. The mechanical trend is pointing down. The range is below the 200-period moving average. So I'm going to be biased to the bearish side. What I'd be looking for here would be a breakout and pullback setup to the downside because it's in line with the mechanical trend. Now price is flipping over. So price is above that 200-period moving average, below the 50. So this is really, we're in that phase 2 resting. So maybe what I want to do here is now reevaluate completely and just say, you know what? There's conflict now. It's tried going one way, it's tried going the other. Let's just wait for it to make a clear and distinct direction. Just like we went through on the NASDAQ. On the daily chart, NASDAQ's in a range on the daily. We're waiting for it to make a definitive breakout. Oh, just been filled on something. Make a definitive breakout. I wasn't expecting a fill. What did we get? Oh, pretty cool. Sorry, folks, I was just not expecting an order to be filled. Very, very happy that it's been filled. Okay, so I took my eyes off the ball looking at my other monitor. As it turns out, price is now back below the 200, back below the 50. There's the price below. So now we're back into trending mode. So there's the breakout, there's the pullback. I'd like to see go below and carry on moving lower. And I don't know what's going to happen, but if the trend, a newly established and early stage trend is going to continue, then if it goes below $116.95, then that's going to be great. So I'm waiting for that new direction to confirm. There it goes. Without the benefit of hindsight, turned out to be a very quick in and out. But what I can start doing is deciding, well, is this a good logic or a bad logic? Is it just the fact that, hey, just on this occasion it didn't work out? Or over a period of time, over consistency, I get to practice my methodology. I get to practice my strategy. I get to practice my understanding of how the charts work and how the charts unfold. That's what I get to practice. I get to do it in real time without the benefit of hindsight. There's the bearish direction continue. And it's all relative to having a simple, logical, methodical process that we can follow. That's it. It's a simple exercise, folks, but does everyone get this? It took us 10, 15 minutes to look at it today, but it's how do we get experience fast? How do we do it at the hard right edge of the chart? How can I use the framework that I use to help me determine trades and directions and, trends? There's our kind of continuation. How can I follow the process that I normally follow and not have to wait 6, 8, 12 months to see if I can understand this process any further? How can I speed up my learning curve. And again, in the context of what we would do, there's the trend, there's a rally in a downtrend. As it goes back below the 50, there's our reversal pullback. If we were looking at this as a swing trade, a retest of the low, we just looked at the exact opposite trade on some of the daily charts. Retest of the low, target one's being reached. We're seeing another rally in a downtrend. You know, is this going to be turning? The fact that it just took the low out and didn't continue would be a concern. Maybe we're seeing the deeper retracement right now. Want to see it go back below the 50-period moving average and do that type of pattern again. If that was developed over here, then maybe we're going to see a further retest of the low. The new low is there. There's the push. There's the pullback, looking for the retest of the low. This is all what we would look for on the daily chart for swing trades. It's what I'd look for if I was day trading on a 5-minute chart. Waiting for that to complete. It's now made a new high, so that trade idea would be void. Still looking at the deeper retracements. I've got 1, 2, 3, 4 points of connection there. Maybe I can connect a trend line. Maybe I can draw a parallel. So price is in a range. The context of the trend is still down. So maybe what I can do now is take a reversal off the range high and wait for the break of the range low. So we're in a visual range. Right now we're in the middle of the range. So wait for the break. I don't have to wait 6 months for the range to break. I'm probably going to have to wait for 2 or 3 minutes. So we're moving above the 200-period moving average. The 50-period is about to cross above. We're about to see the bullish cross. So we've got a new early stage trend potentially happening. So as price goes above that range, we've got a breakout. Mechanical trend has changed. Visual trend has changed. Buy the next dip. Wait for a retracement back to the 50, just so we get the trade at a discount. And everyone see this? Sometimes feel that this type of analysis, it's a little bit abstract, but I'm not going to trade it. I'm not planning on scalping. I have traded this way and it's intense. There's the deep retracement that we were looking for a move back to the 50. Didn't quite get there, but I think it's deep enough. Entry above the pullback high. Buy the dips. Where can it get to? Let's measure the heights. That distance is the target. So I'm looking for a move up to there somewhere. What? Why there? Last move did that. Last move did that. So I've just projected it up from the high, and that's where I got 20 cents from. I'll find out if I'm right in a minute or 2 or 3. Price is moving into a consolidation. I'd be thinking if I wasn't in a trade, I'd be waiting for a new breakout. There's a new breakout. Still looking for 1,720. That's what we're expecting it to get to. Again, the scale's changing, so it's just gone off the chart. So I've just written it. Buy the dip. So does this make sense, folks? We have a simple way to think about speeding up the learning curve. How can I get experience fast? How can I practice in real time without fear of losing money? It's all paper trades. And how can I start making decisions and evaluations and looking for the best opportunities and planning it and learning how to use tools and indicators? Maybe I want to use the moving averages. Maybe I want to use an indicator. Maybe I want to read price action. Maybe I want to practice Dow theory, Elliott wave theory, GAN theory. But we get to practice without the benefit of hindsight. And that is really how you're going to push your experience level, your skill level beyond the boundaries of where you're at now. Choose the time frame that suits you best. Let's go back to the daily, choose the time. Well, there we go. We looked at that setup. That was on the 15-second. This is the daily now. That was on the 15-second charts. If you remember that exact same pattern. Does everyone remember that? The exact same pattern was on the second chart in the first 10 to 15 minutes of the day of Apple. So the same patterns develop over and over and over and over again. History repeats. As a chart trader, we've got to believe that history repeats itself. So with that said, does that resonate, folks? Does that help? Did that make sense? Did that give you a way to think about speeding up your own learning curve and to think about practicing how you may trade? And that's how you can get 20 years in 20 minutes. But just before we sign off, just give me a little comment. What did you think of the session today? Did it make sense? It's a little bit abstract, but ultimately change the time frame, keep going lower and lower and lower until you've got a pace that makes sense. Having a pace that is fast so that you're not thinking between decisions. You saw me do it. And obviously I'm used to, I've done this a lot, but you might start off on, say, 30-second charts. There's plenty of time on a 30-second chart for you to go through the checklist, go through the process, go through the motion that you want to practice and follow and fine tune and hone. And it just allows you to speed up that learning curve. Awesome. Just reading the comments, folks. Thank you kindly for your feedback. Colin, Jacob, Zach, really pleased that you got a lot out of this. Duncan, great, awesome. All the patterns are exactly the same. I think as a nice little way to kind of a little bit of confirmation bias, I just find it interesting that there's the gap on the daily, there's the rally, sell off, there's the lower range. We saw that exactly the daily chart here, and we saw it on the 15-second chart. So if you want to go and have a look at that, Friday the 27th, we've got a half day today. It's holiday, but you can go and have a look at the kind of the way that it unfolded. Now, what would be interesting is at the end of the day, the end of today, to go back to the 15-second charts and go and cheat. Go and look at what happened next on the 15-second charts. And maybe that's going to give you a clue as to what will happen on the daily, because it's exactly the same pattern that we looked at on the daily as we saw on the 15 seconds. Go and look back with the benefit of hindsight today to give you a clue for what might happen tomorrow on the daily. That's where the magic of this really happens. That's how you get experience. Folks, thank you for your time. Thank you for your feedback. Ruben, I appreciate your comments. We did talk about this earlier in the week on the podcast. It's not the first time that we've spoken about it at any great length. I've done several videos in the past, but this is a good illustration of, it doesn't matter what the time frame is, the pattern is there on every time frame. If it helps you think about this in a slightly different way, price behavior is determined by human behavior. So what you're trading is crowd psychology, and human behavior doesn't change and hasn't changed in 1,000 years. We all behave as a crowd in a very similar way. So that's all we're doing. The charts are a visual representation of crowd psychology, and the crowd is the same weird ass trader on every time frame. So go and do with it what you will. It will help speed up your learning curve. And again, once again, thank you for your time, your attention. Thank you for spending your week with me. And just a final reminder, if you'd like to learn a little bit more about the VWAP momentum strategy, and you want to learn in the smartest possible way and look over my shoulder, I'm going to be starting workshops imminently, maybe as soon as Monday. If you would like to be involved in the real-time training, the real-time trading, then send me an email, phil@antivestor.com, and will help you become the best possible trader in the fastest way that you can learn, which is over my shoulder and following in my footsteps. So that's the strategy. That's what I'm trading quite actively right now. And you can have the benefits of watching me do it in real time and get the benefit of my 20 years experience in your 20 minutes. Right, folks, I will see you all same time, same place next week. Have a fabulous weekend. And as always, make sure that you find some time to smile, to enjoy yourself, and just, appreciate life in general. We don't know what's going to happen tomorrow, but just make sure that you enjoy today. And with that said, I'll see you all next week. Bye for now.